Ladies and gentlemen, K Kim here with the Traders Club. Welcome to the market update. Today's Saturday, December 21st, 2019. Thank you for your patience. I really didn't feel like doing a video yesterday, so I decided to do it today. And I'm in a much better, more energized mood today. Just as I was a little bit busy, so I think I made a good decision to do that. As always, as usual, let's start with the spider for our weekly analysis. Qs, diamond, Russell, semi, or the banks, and the semi. We'll call it a day after those tickers there. And I want to thank you for spending time with me on your weekend afternoon. And this year has been a great year for me, and I hope it was a great year for you guys. And I've been kind of navigating through this market together, trying to help you guys to navigate this market with these volatilities we've seen, this year. And starting from late December, we saw that abrupt 20% decline. And I said this to you guys, I didn't see that one coming. I really didn't see that 20% coming. So I think it was crucial for me to make that decision. What do I do now, right? Because you guys know that I've been long since 2016 lows. I've been always kind of a trader, swing trader. And when I swing trader, I really swung. I mean, like I held things for like a month. So it was always swing trader, and I became a long-term investor and became a position trader. So basically, I started doing things much, much longer term. In 2016 lows here, that's when I started accumulating long-term positions, and that's when I started trading leaps, right, instead of just monthlies and things like that. So it's been working out well, but like I said, I you guys know that if you guys been following me long enough that I've called this move and I called these bottoms. What I didn't see was I didn't see this one coming. So I think the question was, when we did see that 20% decline in late December, what do I do now, right? I think this first decision was, well, why don't I close out my positions, kind of preserve what I have remaining, right? Because there's a risk of a recession or crash, right? Or bear market, right? Maybe it's better to not lose at all and just to preserve what you already have. Or two, don't do anything. Don't do anything and see what it does. Three, you buy, right? So I went to work and I did my analysis, and I've done videos for you guys back in late December and what I was expecting the market to do. And I think a lot of things happen, 2000 and 2019. I tell you a few things, and I talked all about this before. I wrote a blog about it, and so I just want to recap everything today and review it. But, we've never seen more than 10% decline more than once in one single year. And I think that's why so many people got wiped out, because we saw in January that 12% decline. So we've never seen in history of stock market on the S&P or other indices where we see 12% correction, 12% or 10% or more in 1 year, and then we see another one next year. Usually it happens 1 year and then happens next year, right? And that's kind of what happened in 2015. I mean, they're close together, but you can see we saw that 15%, right? And then we saw next year. See, it didn't happen till January. So they're close together. But what happened was, because it happened in January, you know what I mean? Like it happened in December. And you say, well, why is it important? Well, because you probably know this, nowadays we got all these people's stats, right? So people put out these stats like, when this happened, we've never seen happening this, or in our stock market, we've never seen two 12% or two 10% or more corrections 1 year. And that's calendar year. Because I mean, if you look at this will just happen in what? September, August, and then it happened again in January. So that's like what? August, September, October, November. That's like 6 months later. So it's just for the fact that it happened in January that it doesn't qualify in that stats. But that's what problem with this stats. And I think there was a guy pretty popular on Twitter, Odd Stats. he pretty much got wiped out and he doesn't tweet anymore, but he got his popularity very, very quickly. And I remember just seeing his tweets and stuff like that on Twitter, and I just kind of was thinking about him because I think this stat is where I got that from. Maybe it's from him. He said that there's never been in a history of stock market where we see more than 10% decline twice in 1 year. And I think that's why I think he loaded up and then he lost all his money on that decline. This is why we cannot always rely on these stats. And I think stats are good in a reference way. You can look at it as you reference it, but solely trading off of it is dangerous because I'll tell you this also, we've never seen a V-shaped reversal after 20% decline. So think about this. We've never seen 10% decline twice in 1 year, which statistically that is correct, but I just mentioned it to you guys. It happened here in just 6 months time. It's just that this was calendar year 2015, this was calendar year 2016. So when he was doing that statistic work, it never come up, it never showed up because of it. So now that he's thinking that this is not going to happen again was wrong approach, and he believed in that stat, and then obviously we saw the 20% decline, very, very abrupt sell-off. Another thing was, I think I remember this back in late December, early January. Everybody was looking for either a pullback to retest or making lower low. Do you know why? Because again, statistics. Stats tell you that in a history of stock market, when the market faces 20% corrections, we've never, ever seen a V-shaped reversal and subsequently making or getting near to all-time high level, or the peak of where the correction started in just over a quarter of time, or 3 months of time. Never. We've never seen this. Most likely what happens is if you follow these stats, after 20% decline, you're going to see either double bottom or triple bottom, or it'll make lower low first and then maybe do something like that, like invert head and shoulders, or we downright just get into a bear market. Those are the scenarios. We've never ever seen a V-shaped reversal and 3 months later we get near all-time highs. It has never, or at least new that high peaks, the highs where the correction started. We never seen it. So if you relied on the stats only, well, you're wrong here and you're wrong there. So I think, and nowadays we have charting steps. Charting software is prevalent. Everybody you open up online brokerage, you get one for free. There's so many websites that provide free charting software, and we got all kinds of stats that people are sharing. Again, it's good to, I think, use those for reference point, but trading solely off, on it would be, I think, could be detrimental. Just I've shown you because of that, because of scenario here that I've demonstrated and scenario here, right? And I think that's why when this was coming up, everybody was waiting for a retest. You remember hearing those? Everybody was waiting for retest. Everybody was doing retest. And then when we got back here, everybody was waiting for 260. And then when we got here, everybody was waiting for something. And market always does the opposite because market tends to fool the majority. So it's difficult. I don't think it's prudent to solely rely on those stats to trade this market. But anyway, so we're back here. We saw a nice move and a nice consolidation. And I've been navigating you through this market that these are the great level to buy these dips and accumulate more. And then we're seeing another leg higher. And that's how market moves. We get a move, consolidate, some up and down zigzag in action, and then we get up again. And that's what we call an uptrend. So right now we're at 320. I think 320 was my year-end target. I've been talking about this since throughout this year. Next year, my target is 400 by end of next year, right? So, and that's, if you look at this and like, oh my God, 400, it's actually not that much. It's from here, it's only about 24%. I mean, market moved already this year, 28% year to date. So, I mean, if we come shy to 380, are you gonna be mad? No, no, we're not gonna be mad at 380. But nonetheless, 400 is my target. But I won't be mad if we get to 380, right? I'll take that. So I think right now everybody's wondering, well, when are we gonna see a steeper pullback? And something that I've been talking about last several weeks is that, well, everybody's looking for a pullback. When we saw these kind of pullback, everybody was still scared. Why? Because they're still remember what happened in late December. The memory is fresh. They're scared that you can see that we came down, we consolidated a little bit, boom, right? So it's like comes down and consolidates. Like, oh man, I don't know. That looks a lot like here. And so everybody's pretty scared and fearful of this market because memory is still fresh about what happened in late December of 2018. So I think a lot of people are kind of refusing to buy this dip. They want to wait for quote unquote clear signal, right? And then once we break above it, right? Once we break above it, I think everybody's okay. Now they were breaking out. They want to see like 7-8% decline. So maybe they can buy the dip. Maybe they were even drawing something like this. I think a lot of people were. And then they say, okay, I want to see this and coming back down here to maybe about 294 or 290s. And I want to buy that dip. Well, and we talked about that. You may not get it because this was merely about 1.5, about 2% decline. You see how fast we reversed? We had just 1 day of down day. We gapped down, and then just that was it. That was it. Just how quickly we got right back up. Because I think if you missed out this entire year of this move, and you missed out this move, you're waiting for quote unquote clear signal, or you've been shorting, and now the market is breaking out, and now you say, okay, you know what, I want to wait for a steep decline. Now, okay, I'm ready to buy that dip. You're probably not gonna get it. And I've been saying this, and you see how quickly we got up, and people are still waiting for a steep pullback while the S&P 500 is making what, 13% in just 2 months. 13%. We just pretty much went straight up. So now a lot of people are saying, well, there's no way it can possibly go any higher after this. It could. I mean, market could do some unthinkable things. Didn't we just learn that here? Unthinkable thing. How many people really anticipated we're going to see something like that? How many people? I think it shocked the world when this thing went just right back up to new all-time high level in just over 3 months. Market is capable of doing unthinkable things. Can we go to 330 by end of this year? It's very much possible. People who's been taking a risk and buying these dips do have a luxury right now to say, you know what, if it keeps going higher, I'll just hold my positions. If it pulls back steep, I'll buy that dip. But people who's been waiting for the clear signal, people who's been shorting this market is now anxious. Well, how can I go long now? Now the market's breaking out and it's going to pull back. We may even see like little tiny pullbacks, and it could continue to grind higher. Again, market is capable of doing unthinkable things. We've already seen this happening, So right now, I mean, I've been closing out some of my aggressive positions, meaning I've been closing out my call options on the indices. I've been accumulating calls on these levels, and I've been closing out, not all of them, some of those call options at these levels. But my long-term holding positions, I'm talking, my individual company shares, and I also have triple shares on everything. I have triple shares on everything: SPXL, TQQQ, UDAO, SOXL, TINA, FAS, all of them, which I've been buying since December lows and buying all these dips. I'm holding full on all of those ones because I am bullish. I'm gonna ride it all the way up to 400. But for my aggressive positions, those call options, once they have they gained good gains on those, I'm gonna start closing some of them out. And you've seen my journal post my TQQQ journal post where I closed out, I closed out, I think, how much did I close out so far? Let me check real quick, I kind of forgot. So I think it's here. It's my blog here. So I'm up to part 3 now. So I've been here. Yeah, there you go. So yeah, so been buying here, bought this, and then closed 1/3, and then closed half. So I've been accumulating calls. I also have shares, and I didn't close out any of those. But I've been accumulating also calls, and I closed 1/3 here, and then whatever from the remainder, I closed half from the remainder. So I still have some on the TQQ calls while holding full shares that I've been accumulating since December lows and buying these dips. So that's kind of how I've been taking it, or how I've been, adjusting with this move. I'm not like unloading everything. I'm unloading only those call options, and I'm not completely closing them out. I'm just shaving off some while holding all of my shares on individual companies, and then triple shares, because I believe we're going to go higher. That does not mean we're not going to see a volatility. That does not mean we're not going to see a pullback, but I have the luxury to kind of sit back and say, if it keeps going higher, great. I'll continue to hold maybe continue to trim my call options. But if we pull back, I'll be buying that dip. So versus you're trying to figure out what's, where I can go in, because you're waiting for quote unquote clear signal. You know what I'm saying? So again, I think at this point it will be foolish to go short here, but it will be also foolish to maybe trying to go full blown bullish here either. After market just made 13% move in 2 months, this is not a level to do anything. But if you've been long, you've been buying these dips, you've been holding it, then you have the luxury to say, okay, I'm gonna hold mine, see how high can it go. Okay, if it pulls back, I'll just buy that dip. So either way is fine, right? So I think, what I think is that we have, how you got Christmas coming up next week, New Year's Eve week after that. I don't know if we're gonna see a huge move. I think it could continue to just grind like this, just grind like that. Maybe even higher, sideways, higher, little pullback, higher, and pretty much throughout the remainder of this year. I don't know. I don't think we're going to see any big volatility remainder of this year. And I actually think going into next year, I think the biggest correction we're going to see next year, I'm leaning towards 4 to 7 or 8. I don't think we're going to see anything higher than 10 next year. I'm talking throughout 2020. So 2020, we'll see corrections, maybe 4 to 7 or 8%, no more than 10%. That's kind of what I think is going to happen 2020. So I'll navigate you guys through next year with these weekly videos as we're going to continue to follow up on, on the development of this market. Qs just broke out of this. We just had a quick retouch and just quickly moved up here, and same logic applies here, similar to spider, so keep that in mind. Let's go to diamond. Same thing, multi-year consolidation, resistance, support. It's pretty much been consolidating throughout last couple of years, and that's a good sign for the market. I don't know why every time we see move like that, everybody look at it as something. It's because I think most people are just fearful. They're always wondering about recession and bear market. But you can see how market has been moving that way, right? We make a move, we consolidate, and there's a correction, and we run again. And we consolidate, we run again, and we consolidate, and I'm expecting another run. That's what you call an uptrend, right? Everybody likes to talk about Dow theory, right? Everybody talks about, well, transport's lagging. Yeah, so what's happening is you're arguing with one verse with another, Dow theory also suggests the trend is assumed to be in effect until it gives us a clear signal, clear signal that it has been reversed. So what Dow theory is saying is you have to give benefit of the doubt to the buyers until it gives us a clear signal that the trend has been reversed. We're just breaking out here after multi-year consolidation. That doesn't sound like a clear signal now. So we want to continue to give benefit of the doubt to the buyers. Actually, the trend is getting strengthened. The uptrend is getting validated, right? There was a little bit of a, after this move here, there's a little bit of a, some shakiness in the market, maybe some uncertainty. But then when the market got back up to these highs, we're no longer in a downtrend. Because downtrend is, what is the definition of downtrend? Lower highs and lower lows. If this was going to crash, it would have maybe gone up somewhere here, and it would have made a lower low and lower high. That's how you can identify as a downtrend. This, my friend, looks more like an uptrend to me. Let's go to Russell 2000. Russell 2000, we talked about this level for the first time since May of 2019 this year. We have cultivated higher high. That doesn't look like a downtrend. Does it look like a downtrend? Does it look like an uptrend? Higher highs, higher lows. Trend is assumed to be in effect or valid until it gives us a clear signal that it has been reversed. Do we have a clear signal the market has been reversed? Do we even have any kind of signal that we're on a bear market? Are we cultivating an uptrend here or downtrend? Looking at these higher highs and higher lows. Let's go to the banks. Banks, I remember you guys remember the same thing. See, same thing. People always argue about same thing because when the banks were underperforming, because I remember there were times where banks were like 19% year to date while the S&P was like 26 or something like that. Look at the banks now. It's outperforming the S&P. Do you guys remember what is going to be the catalyst of this market to continue to be propped up? It's gonna be the banks. Banks gonna start to outperform, and that's gonna prop up the market. While everybody else was saying because banks are lagging, it's gonna drag everything down. They're saying the same thing with the transport. Let's look at transport. So transport is lagging. 17. We'll add transport. Transport is lagging. So now they're saying the same thing what they're saying with the banks, right? So they're going to saying the same thing. Well, transport is not confirming the Dow Jones Industrial Average. Well, therefore, market ain't going to crash because of that, obviously, because you can't just say, well, I'm vitamin D deficiency, that's why I'm going to die, right? You can't say one thing and say, well, that's why market is going to die. You can't say that. Right? Obviously, right now, transport is not confirming Dow Jones Industrial the new highs, but you gotta look at other things as well. Maybe market is in a perfect condition, but none of us are in a perfect. When was the last time market was in a perfect condition? But here's what I'm saying: XLF was significantly underperforming. Everybody's worried about that the banks are significantly underperforming. Right now, just within a couple months, XLF is outperforming now the spider, right? That's what's gonna happen with transport. So how are these markets gonna be continuing to prop up? We're already at extended level, quote unquote extended, overbought level. So what is gonna be the catalyst that this market is gonna keep grinding higher? Well, guess what? Transport is extremely underperforming, 17% year to date. Even Dow is 21, 22. They're also underperforming. These guys are gonna start to go. Money rotation is gonna start to occur, because a lot of these tech sector and these chip companies, they're extremely, I don't want to say overbought, but they're up a lot. So maybe some of these investors and smart money is going to is going to trim some off from these, some of these stocks that has gained a lot of return, like Apple. Like Apple's gone up a lot, so I've actually I closed out at 1/3 of my holding shares on Apple recently. So maybe that money they shaved off, maybe put that money And maybe some of the semiconductor as well, because they've gone up a lot. So maybe take some off from there. Unknown, maybe 1/3, something like that. Maybe use that money, rotate that money into some of the transport stocks. Did you know that that's exactly what I did on XLF when they're extremely underperforming? I was actually buying XLF calls. I was not able to buy calls on a spider and other ones on Qs because I already bought those and they're already gone up. But XLF was, significantly underperforming, so I bought a lot of those calls. And I mentioned, you guys remember? I was buying Goldman Sachs, I was buying JP Morgan, I was buying Morgan Stanley, I was buying Wells Fargo, I was buying Bank of America, Citigroup, I was buying bank stocks. I was accumulating bank stocks, and I was buying XLF calls, and I was buying FAS, which is triple shares for Russell 1000 financials. So maybe the smart money is doing the same thing. Yes, NASDAQ semis are overheated. Maybe then take some off from those overheated stocks. Take some profit. Don't close out everything, but take some off. Rotate money into transport stocks. And then as the transport stocks move higher, that's going to prop up the overall market. Because that's exactly what happened on XLF. Do you know that Russell 2000 is now outperforming Dow Jones? Because everybody was saying the same thing about Russell 2000. People were saying, well, the small caps, and the banks, man, they're underperforming. They're going to drag everything down. And I've been telling you guys, no. Because that's exactly what I was doing on the Russell 2000 as well. I was accumulating triple share in the Russell 2000, which is TINA, and then buying call options on IWM. Right? So I was shaving some off on some of those overheated stocks and indices and rotating that money in some of those lagging indices. Maybe and as the Russell 2000 breaking out, the banks are also breaking out, that's propping up the spider and the Qs right now. So now you can see transport is underperforming greatly, 17% year to date. Now maybe smart money is taking some off on some of these overheated stocks, take some, profit, and then put that money into work, rotate that money into transport stocks. And as they do, this market continues to be propped up. Look at the semiconductor here. Broke out of this, hit a quick retest, right? And then we just shot right back up. So let's continue to give benefit of doubt to the buyers. Can we see 330 by end of this year? I don't know. But for me right now, it really doesn't matter. I have the luxury to kind of sit back and say, you know what, if it keeps going higher, I'll just continue to hold the position I'm currently holding, and maybe I'll continue to shave off some of the, some of my call options and things like that. But if we do see pullback, I'll buy that dip. So I have that luxury to kind of sit back and just kind of let the market sort things out. But I actually feel like any kind of short-term pullback will be bought pretty quickly, and this market could continue to grind higher, maybe to 330. So that's kind of what I'm thinking right now. So we'll follow up again next week. I will have the market update video on the 27th or 28th, or that weekend, 27, 28, 29, which will be the last market update video for the year of 2019. I hope that you guys, I'm having a good year this year, and I think market is going to thrive also next year, and I'll continue to navigate you guys through these market update videos on a weekly basis. So you guys have a wonderful weekend, and good luck trading next week.